normal. A year ago right now, the 10-year Treasury on today was 147. We're at 145 this morning, right? We're not that much different. So the curve looks a lot different, absolutely different. A year ago right now, the curve had a smile in the short end and then a gradual incline going out. Today, it's, the front end is pegged at basically zero, and then to your point on the belly of the belly of the curve is ridiculously steep. The roll down effect in the belly of the curve right now is really ripe for investors to take advantage of. But let's not mince words. The long end of the curve is still going to go higher.
I look where we are, Daryl. So wonderful to have you with us today. And I've been dying to ask you this question with your work at Boston University years ago. What would Zvi Bodhi say? The great Zvi Bodhi would look at the complete rupturing of anything normal, anything in the textbooks, and say, how do we go from here? What would Zvi Bodhi say about the linkage of corporate finance to investment right now?
I think he'd be a little concerned, to be honest, Tom. I think he'd say, the linkage to corporate finance is, the floodgates are open. The liquidity is there. We saw it all last year. It's going to be there for some time. I mean, the reality is liquidity is abundant and it's predictable, right? Not just Chair Powell, but Vice Chair, Governor Brainerd yesterday reaffirmed this fact. You've got massive fiscal stimulus. You've got a Fed who wants higher inflation. That equates to higher rates. And the question is risk markets, can they handle that? We believe they can because we believe rates are going higher for the right reasons, right? You guys know well that rates can go higher for the right reasons, meaning 5.5%, 6% U.S. GDP growth this year, or they can go higher for the wrong reasons, which is just inflation expectations rising higher and the term premium going up with no growth.
So, Daryl, at what point are bonds a buying opportunity for you?
I think you've got to see the 10-year closer to probably 175 later this year before it really kind of settles down. I do think you'll need some technical resistance here right around 148, 149 on the 10-year. But we think you need to kind of be overweight equities here, Lisa, and really play defense and protect in the bond market, particularly on your duration side. As I mentioned, when you look at that 10-year at 145 all the way down to the 1-2 month at 4 basis points, 5 basis points, the roll down effect is huge there. That's where you can make money as a bond investor, but you have to protect duration here.
Daryl, thank you, sir. Good to catch up. Longer conversation next time. Daryl Cronko, One-Star Wealth and Investment Management CIO. Yields up, Tom, 7 or 8 basis points on a 10-year to 145.
And we'll see where we go through the morning. I just love what Peter Bookvar published over at Bleakley, Jen Farrell. The idea, I love this phrase, in-your-face QE. That really describes where we are right now, isn't it?
Well, what's the objective of QE? What did it used to be? What did it used to be?
Which one? 1, 2, 3,
QE
4?
1, 2 in the early days, QE 1. It was about pushing you out of the bond market. It was about getting long-term yields high. They didn't want you there. They wanted you investing elsewhere. Now it seems to me that over the last couple of years, we started to view bond buying as something to cap yields, not to push yields higher.
I go, and John, it was the great Zvi Bodhi, a great mentor of mine as well at Boston University. John, it is so artificial right now, and again, as we look at yields moving, we forget that.
Yields up, and yields up on a real yield as well by about 6 basis points this morning to negative 73, just short of that level. And Tom, that's got to be the story for big tech as well, and Nasdaq rolling over, Nasdaq futures lower.
Nasdaq futures lower. I want to see where we are at 2 p.m. because it seems like every day we go through this agony on our simulcast, and then 4 hours later, after the properties, boom.
A little bit later today, in the next hour, in about 50 minutes actually, David Malpass, World Bank President, really important conversation coming up a little bit later. From New York City this morning, good morning to all. Yields are higher, equities are a little bit lower. We're down 11 points on the S&P 500, down a third, call it a quarter of 1%. Alongside Tom Keene, Lisa Abramovitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
From New York with the First Word News, I'm Karina Mitchell. The White House is targeting key states to try to build support for President Biden's $1.9 trillion coronavirus relief plan. Biden and his aides are pitching the bill to mayors, governors, treasurers, and tribal leaders. The administration is focusing on 13 states, among them Ohio, Pennsylvania, West Virginia, Arizona, and Georgia. The effort serves as a dry run for an even tougher sales job on the next stimulus package. Over to China, it is dismissing U.S. efforts to shift supply chains towards alternative sources as unrealistic. That came just hours after President Biden signed an order aimed at ending the U.S. reliance on China and other adversaries. The president directed his staff to address shortfalls in semiconductor production. The shortage has idled production at some auto plants. Meanwhile, questions are being raised about the infrastructure Americans rely on to process payments. For about 4 hours yesterday, Federal Reserve systems that execute millions of financial transactions a day were disrupted. It appears to have been some sort of internal glitch. The system processes everything from payroll to tax refunds to interbank transfers. Public health experts say a new study finds immunizations could end the coronavirus pandemic. The study published in the New England Journal of Medicine reveals the Pfizer-BioNTech vaccine was overwhelmingly effective against the virus. Researchers followed nearly 1.2 million people in Israel. Global news 24 hours a day, on air and on Bloomberg Weekday, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
You're listening to Trade the News.
feel we have a very good chance to not only have a positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
People out of work still in this economy. We think that this is appropriately sized and frankly the right kind of economic prescription to what is a unique and really precarious moment in our economy.
We have 10 million fewer people working on payroll jobs than we had just 1 year ago today, and that the unemployment rate, the report 5%, but if you include people who were in the labor force and indeed working in February and a couple of other adjustments, you get to almost a 10% unemployment rate. So there's a lot of slack in the labor market and a long way to go to maximum employment.
That's the message from the Federal Reserve, from Chairman Jay Powell in his semi-annual testimony this week. From New York City this morning, good morning. Alongside Tom Keene, Lisa Rabbits, I'm Jonathan Ferro. Live on TV and radio, here's the price action this Thursday morning. Good morning to you all. 1 hour, 12 minutes away from jobless claims in America. Yields off the highs of the session still up by almost 7 basis points to 144 on a 10-year. In the equity market, just a slight softer move lower, down by 10 points on the S&P 500, off by 0.25%, much more so on the NASDAQ. Thought it was really important just to monitor the shift in emphasis from the Federal Reserve in the last couple of years, Tom, away from unemployment to employment. It's really, really important. 10 million fewer people employed now versus 1 year ago, and that's where their focus is.
Well, the social message, where they began with Charles Evans out of Chicago, I can't remember when that was, but that meeting at the Chicago Fed 18 months ago or so was really, really important. John, we need to recalibrate on 800,000, as Lisa Bramwich mentioned earlier. If we get a 700,000 handle on job claims, what will that do to the markets we're observing?
No idea on the market. I think a lot of people right now are looking for claims to collapse a lot further down the road, Tom. There's still massive churn. We haven't reopened just yet in the right way, I think, to really get people excited about that number coming down aggressively anytime soon.
Kevin Cirilli, our chief Washington correspondent. Now, Kevin, John and Lisa want to talk about the issues at hand. I thought Jim Vanderhei over at Axios really captured it nicely with a single, 5-word sentence. The GOP needs 6 seats to take the House in 2022. That's going to be a message for former President Trump this weekend. That's a shocking number. I think, Kevin, a lot of people across America don't realize that +6 number.
You know, Tom, you're speaking to the political junkie in me, and Vanderhei really captures this in his morning note over on Axios. But 3 points here. First and foremost, by focusing on the state legislators, it's easy free media in local media markets, because the headline is simple. State lawmaker says X. That's how former President Trump was really able to keep alive the invalidated claims with regards to unvalidated claims with regards to voter fraud in the last election. They had a whole operation targeting some loud, outspoken state legislators in battleground states like Pennsylvania. Secondly, when I mentioned this on air last week, when I talked to sources who still talk to former President Trump, what they say is that he's going to be organizing not just a super PAC to impact the House, but also to take back state legislators and to impact policy at the state legislator level for voter ID laws. And then finally, CPAC, you mentioned it, it's this weekend, it's down in Florida, it's not being held virtual, and this is Trump's, it's already being positioned as Trump's comeback of sorts. And I was struck again by Senator Romney's comments earlier this week that said that he would win a 2024 primary.
Is there a Republican middle that can be part of a $1.x trillion stimulus? Are they so distracted they don't exist?
You know, if you subscribe to the notion that this political infighting in the Republican Party will be able to attract a larger tent and a bigger tent party, then yeah, we could be talking about in a couple of years the great Republican comeback where they were able to have a mind meld, so to speak. But yesterday at the press conference, I don't know if you caught this, with at the Republican Conference weekly press conference, Leader McCarthy was asked if Trump should speak at CPAC. He said yes, and then right after that, right standing off stage, was Congresswoman Liz Cheney, and she's got her mask on, socially distanced, and says no, he should not.
Well, there definitely is a lot of confusion with respect to who the leadership is going to be of the Republican Party going forward. Joe Biden is trying to go beyond politics when it comes to pushing forward the $1.9 trillion stimulus package, not just when it comes to getting it through, which seems like a done deal, but also garnering enough support in the popular vote, right, among the rank and file of America, in order to push through some of his other priorities. There was a great story on the Bloomberg today about that. How is he going direct to voters to try to get popular support for getting free money, but also for some of the other initiatives in this bill?
Well, he's hit, to some extent, the virtual campaign trail. You know, he was in Texas. He traveled to other states in the Midwest to try to drum up support here. But when you got Ron Klain appearing on MSNBC, the president's chief of staff, clearly they know that they have a huge, massive battle on their hands, and they're starting to read the political tea leaves, which is that the patience of the White House press corps has started to run thin. And so I think that they're at a major crossing roads, and that after the passage of this stimulus, it's going to be fascinating to see whether or not they can get support for infrastructure.
Kevin, just give me a bit more colour there. Patience running thin. Why?
Well, look, I think that you've got a press corps that was used to the Trump media, and then in comes the Biden administration. There's a contrast in that. There's a lot of socially distant procedures in place that have changed, so to speak, the culture of Washington, D.C. But beyond that, it's not just the media, it's also the divide in the Democratic Party. And that has been one of the most underreported dynamics as we move forward here, because the tension is mounting in terms of the Sanders, Elizabeth Warren wing of the party and the Biden administration.
The next election feels like a lifetime away, but Kevin, increasingly we keep discussing the Republicans, the division within the party. Do you think the focus should be elsewhere then?
Well, I mean, and I was hesitant to say this in President Biden's first 100 days, but I think it's a really smart point that you're alluding to, Jonathan, which is, when does the Biden administration say whether or not he will seek a second term? Because that will jumpstart his ability to have political capital or not in terms of policy. And removing the politics, which clearly that has implications for, from a policy notion, if you're trying to understand the short and long-term policy being forecast out of Washington, that actually is an incredibly monumental moment.
Is that a story for 22 or beyond?
I don't know. People don't want to talk about it yet, but I've definitely been fishing around on it. But I don't think you get that answer by the end of this calendar year necessarily. But it's only a matter of time until that's injected into the mainstream media discourse.
Kevin, thank you. Kevin Cirilli, Chief Washington Correspondent and, of course, host of Sound on Bloomberg Radio, weekdays at 5 p.m. Eastern Time. Patience running thin, Tom. Patience running thin.
Yeah, well, patience is running thin, and you just went over very nicely the political maelstrom that's out there, John. The bottom line is, it's February. And you said this a couple times, John. We're like deep into 2021. What are we going to be talking about in May?
I don't know, 2% 10-year yields, Tom. Who knows at this rate? 3? I don't know. I'm joking.
It's just February. It's like a continuation. I thought last year was over December 31st. I was wrong.
I'm really looking forward to the conversation coming up next. It's Eric Nielsen of UniCredit, the chief economist. And over the weekend, he got out front of what's happening in this European bond market and how the ECB would respond to it. Really, really important conversation coming up. As you look at the market, the price action right now, this Thursday morning, good morning to you all. We look a little something like this. Yields up 6 or 7 basis points to 144 on a US 10-year. In the equity market, we're down about 0.2%. It's a no-drama story still, Tom, for stocks.
It's still for stocks until we get to 12 noon today or 2 p.m.
Then things start to change as they did yesterday. Maybe. We'll talk more about that from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Futures down just 0.2%. This is Bloomberg.
Go to cash.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at those leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on TV and radio. I keep this short, quick, snappy. Futures down 0.2%, outperformance on the small caps, underperformance on big tech. The Nasdaq off by 0.75%. The why? Real yields just starting to push a little bit higher. Once again, let's get to the bond market. Switch up the board, 2s, 10s, and a spread between the two. Yields up on a 10-year by about 7 basis points. The one from the board. Unwarranted timing of financial conditions. Who did we hear from today? We heard from Philip Lane of the ECB, pushing back against what we see. And what did this bond market do? Did not blink. Yields up on the French 10-year by 5 basis points, the German 10-year by 5 basis points, the Italian 10-year by 7 basis points. And Tom, here's what's interesting for me. When does the central bank start to push back in Europe? It's when yields go through 0 on a French 10-year. It's when the German 10-year comes inside the depot rate of the ECB at -25. It's when the Italian 10-year is at 76. The ECB does not want these yields to go any higher. They want them to stay at exceptionally low levels.
Now let's recalibrate the tipping points here. We'll do that after Romain Bostic on the markets. But John Farrell, you're right. The tipping points here, to calibrate them, to search for them, to find them is critical.
So in Europe we're there. In the United States, not quite yet. And there's a bit of tension here evolving that we'll touch on with Erin Nielsen of Unicredit in just a moment. Let's get those movers. I know you want some GameStop. Here's Romain.
Well, John, I mean, we were actually having the discussion you were just having last night on our show on Bloomberg Markets to Close. Taylor Riggs was regaling us all about sigma, delta, and correlation coefficients. Then GameStop happened, and we ripped up the script and turned to the most important story of the day, probably the most important story overnight here. Of course, there was that massive run-up in GameStop yesterday, 100% gain during the normal session, and then, of course, in the post-market session, it doubled again right now here, looking like it's going to open potentially up as much as 55%. All of this seemed to start with a relatively cryptic tweet by Ryan Cohen, of course, the activist investor who took a stake and some board seats in GameStop. It was basically just a picture of an ice cream cone from McDonald's. That just set off a bunch of wild speculation about what that could mean, what it could mean. No one really knows. All of a sudden, you saw volume just go through the roof, and then, of course, within about an hour, the shares were up about 60%, and then the momentum just kicked in from there. Everything else related to that trade basically took off.
I don't need an ice cream cone. Here's what I know, Romain. The short interest now is radically different than it was 3-4 weeks ago.
Absolutely.
What does that mean to you?
Well, what it means is I couldn't figure out who would actually, first of all, who would be buying, who would be writing naked calls on this, because the option activity was through the roof. You would think that anyone sort of on that side of the trade would have learned their lessons the last time around. Again, we should just be very clear. There's no fundamental reason why this stock moved or any of these other stock moves. But again, we talk about the hearings that we had last week and all the talk here about the structure and the microstructure of this market. Something to keep an eye on here as we move into the open. We will go into a more formal discussion, of course, about what's happening with fundamentals and yields. And I want you to flip up the board here and just real quickly hit at some of those fundamental stories here, because Tesla's actually been moving here in the pre market. Some concern here that they shut down production 3 days ago on their Model 3. That's relatively normal. You have these temporary suspensions on auto production lines. So the issue here is that they didn't actually make an announcement about it then. It's not really clear why they did this or when it will resume. Based on Bloomberg reporting, this is going to go through at least March 7th. Moderna out with earnings. More importantly, they came out last night. They gave a broader strategy about their COVID, what they're going to do with regards to the next round of COVID vaccines. Then they came out with earnings this morning. The earnings were good. Their chief medical officer is leaving, though. Not quite clear why. He's been there since 2015, so he's not exactly new, but some concern here that in the middle of all this, that they knew about their chief medical officer to stick around. In Best Buy, interesting numbers here. Comp sales were well below what the street was looking for. More importantly, the company saying that its growth rate on those comp sales is going to go from about 12.6% this year to maybe only about 1% for the current fiscal year. So a big drop down, that pull forward we saw with all those folks running out to buy printers and computers not really lasting, sustaining itself now.
Brian Bostic, thank you so much. Right now, one of our interviews of the day, what we pride ourselves on is good perspective across assets. Eric Nielsen does this wonderfully at UniCredit. You know I've called him the great Euro optimist before. As John Farrell mentioned, a prescient note this weekend on these interdependencies that we see in the market. John, let me cut to the chase. Eric, let me cut to the chase because I know John has some really important questions. At what point of a euro dollar does Lagarde, Lane, and the rest of the elites of Europe begin to sweat? Is it 125 or is it higher?
I don't know the answer, but I would think that 125 would be a problem, particularly if you go there quickly, right? It's speed as much as level. I think most people would argue that the fair value is 125, 130 or thereabouts, so no real sweat. But if it moves quickly, they don't like it, right? But as I argued in my note and we talked about, I think they should focus much more on the curve and the yields than on the FX. Much more important for financial conditions in Europe than the euro dollar.
Eric, let's talk about that, and I'll say it for you. You got out in front of this on Sunday in your morning note that one central bank's statement of confidence, the US, the Federal Reserve, the Treasury market, is another central bank's tightening of financial conditions, an unwarranted tightening. Europe, the ECB, the bond market, Italy as well. So Eric, let's talk about that. Why is what we're seeing in Europe an unwarranted tightening of financial conditions?
Yeah, I think you can cut it down to the following. You have a massive fiscal expansion coming in America, and you have, generally speaking, a better outlook for there's always this discussion about how much can you talk and how much can you actually generate things without doing it. But as I think was it Hank Paulson who said, you want a bazooka, but you have to show them the bazooka and willingness to use it. Then the talk would more or less do it by itself. Lagarde tried that on Monday, but a bit broadly speaking, now Philip Lane is coming out with something more robust, and I'm sitting here looking at the text, you probably have it also, where he says they would use the PEP to buy across and flexibly in order to prevent any tightening of financial conditions that is inconsistent with the countering of the downward impact of the pandemic on the path of inflation. Very clear word from Philip Lane here.
Eric, this is kind of sacrilegious, but taking a step back, are interest rates where they are, or perhaps lower than where they are now, or they were perhaps last week, are those stimulative? Are those going to lead to more inflation?
Yeah, they're stimulative. I think there's little doubt about that. But it's the debate that we who are in Europe in the camp of go big, the pushback we get from the other camp is, but you forget to say that it is stimulative. Yeah, but it's not stimulative enough. If you can't forecast growth that brings back the level of GDP to pre-pandemic levels in a reasonable amount of time, like in the US, and you can't forecast inflation even approaching the target, and I'm not talking about the short-term spike right now, then for me, policies are not stimulative enough. right? And that's what they should look at.
I guess that, Eric, what I'm struggling with is that a lot of people took a look at the negative yield experiment and they said it has not borne fruit. We have not seen inflation pick up. There are people who say it would have been worse deflation if we hadn't had those negative yield rate policies in Europe. But other people say it's actually dampening inflation longer term because people get less income, have less to spend, and it actually has a deleterious effect on the flow of money. Where do you weigh in on this?
Yeah, I don't really buy the argument that it's counterproductive per se. It's counterproductive because it's a tax on the financial intermediation, and therefore they have to do more in the terms of the LTROs or negative rates for the banks to lay down and all that sort of stuff. But my view is, if you go back, negative rates in Europe was a mistake. They were done at a time when others did QE, but Draghi felt politically he couldn't get it through. So you try this experiment they've done in Switzerland and in the small Scandinavian countries, incidentally done that because of FX considerations to avoid the appreciation against the euro. So they tried that to see if they could get away with that. And when the negative rates in the eurozone didn't work, then Draghi finally persuaded Angela Merkel that the world would not come to the end if they did QE. And then you can't come out of it again in a sense.
Eric, final question for me. I think something really important happened this week. The chairman of the Federal Reserve at times has acted as central banker to the world. This week, Chairman Powell did not. He acted as the central banker of the United States, which is his job. So when he saw Treasury yields drifting higher, he said it's a statement of confidence. I just wonder if this persists, the move we're seeing globally, and in your mind, if it's an unwarranted of tightening financial conditions in Europe and beyond, Eric, largely because of what's happening in the United States, how much longer can Chairman Powell maintain the position that he started this week?
Well, I don't think he's too worried about the world right now. I mean, and he is, as you said, he is the Fed chairman for the U.S., and that's his first priority. So it's only when he starts to do his analysis, or his people do the analysis of what is the negative impact on Europe and on emerging markets, and how does that then feed back to the U.S. economy, that he will start to worry. I think he's doing fundamentally the right thing. My concern maybe in the U.S. is that by being so dovish, and you see the higher yields, that you could get a stock market adjustment because you start to discount by much higher rates now. So, and that of course that's been full effect. But I think we are a good long way away from the Fed changing tone now. It's sort of tied himself to the mast by now, right?
Yeah.
They do the fiscal and they just sit back and let's get some inflation and job creation. As you said in the previous segment, I completely agree. Very important shift from unemployment to employment, and good for them.
Eric, great to catch up, sir, and great note over the weekend as well. Looking forward to this weekend's note too. Eric Nielsen there, UniCredit Bank Group Chief Economist and Global Head of CIB Research. Tom, a really important shift's taking place this week in the world of central banks.
Huge shift, John, and just as Dr. Nielsen is speaking there, we see DXY begin to retest the weakness of about an hour ago. I really want to make clear, John, to those on radio, those on TV, these are really markets on the move, even though it seems a jumble.
Europe doesn't want a stronger currency. Europe doesn't want higher yields. The chairman is comfortable with what he sees at the moment. When do we start to think about a feedback loop if this continues, Tom, from the rest of the world?
It could be a deflation spiral or a feedback spiral.
Don't get Lisa started. There we go. Lisa?
I'll let it go.
Spiral.
She's letting it go. Okay.
Carry on.
Wow. Okay. All right. Lisa Bravitz, Tom Key. I'm Jonathan Ferro. Coming up in the 8 a.m. hour. That's in about 20 minutes. David Malpass, World Bank President, from New York City this morning. Good morning. This is Bloomberg.
In New York with the First Word News, I'm Karina Mitchell. A new study says the Pfizer-BioNTech vaccine could help end the coronavirus pandemic. The findings reveal 2 doses of the vaccine were overwhelmingly effective.
See the yields steady after the earlier run up. The U.S. 10-year just just above the 1.45% level. The German yield just under negative 0.26%, and the French yield holding on to positive territory. Euro steady after the earlier climb to 123.37. It's about just a couple pips off its best levels. no scheduled data at the top there, or 45 minutes from the US GDP data.
playback. Good morning. It's 7:59 a.m. New York. About 90 minutes before the stock market opens. We got news today. We got trades to set up. We got things to talk about. So welcome to Forex.Today. Let's get on with it. Let's go. Let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So good morning. Welcome to my office. Welcome to Forex.Today. Let's get on with it. We got lots of things to do today. I got a lot of fundamental stuff I thought I'd bring up. I think we got GDP today, right? Isn't it? Time for GDP. So anyways, lots going on. Thank you for being here. Thank you for being a subscriber. Thank you for clicking that like button. Look, yes, it strokes my ego a little bit, but really what you're doing is you're telling YouTube this is quality content and that they should be promoting it to other people interested in the foreign exchange market. Yes, I don't pump and dump you into trades. I don't get you all excited. Go, 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 trade, trade, trade. It's not about making 20 pips today. It's about technical and fundamental analysis, creating trade plans based on macroeconomics, really coming down. What I'm here to do, in my opinion, is teach you how the market works, why it behaves the way it does, so you can make better informed decisions on your trading and investing, and maybe be in your trade longer than 20 minutes, because that's not a career. Okay? So anyways, ask questions, get involved, take notes, and I will do my best to help. Also like to thank Traders Way for being part of our community as well. You're going to need a broker that you like, that you trust, that executes your trades, that doesn't trade against you, that offers good swaps, good spreads. Did I say fast execution speed? Yeah, all of that. TradersWay.com. They've earned my loyalty and respect. Maybe give them an opportunity to earn yours as well. TradersWay.com. Moving over to the charts. I kind of have a mess of things going on here, and nothing really planned as far as a presentation or anything, but this is what I was just doing. Actually, what I did was I was looking at the worst place in the world. Turns out it's Venezuela. Congratulations, Venezuela, for doing worse than North Korea. And then I was actually just on Google looking for apartment buildings for sale on the beach. But anyways, check this out. This is, I'm on the IMF, by the way. I don't know if you've ever played around with this tool. It's kind of cool. Real GDP growth, annual percentage change, so the change in real GDP. And look at, South Sudan is not expected to do well next year or this year. Venezuela is 500% worse than South Sudan, right? Which makes the South Sudanese super happy. They're like, hey man, at least better than Venezuela. But it'd be interesting if Venezuela ever fixed its problems. There should be some great growth coming out of that. But generally speaking, like this is kind of what I was doing before I got to this page. I was just looking at the change in this yellow line is advanced economies. This is what we thought would happen, a rebound from COVID, right? Okay, that's happening. That's good. And then sort of if you look at the revised version, doing all right, okay, a bit of a revision, which is good. Then you look at, China. China's smoking hot. And then here's the interesting thing, and maybe this will impact things like exotics trades and commodity trades and stuff, but the emerging and developing countries are expected to sort of improve along with the process as well. And in fact, what I'm looking at here is the crossover that has occurred. Okay, this occurred like November, December. And you can see that they're developing even faster than the advanced economies, which makes sense. But I'm wondering if this crossover somehow in the future can be used as a fundamental indicator. Okay. A link to the IMF? Come on, Peter, seriously? The International Monetary Fund? Okay. Yeah, that website is funny. Yeah, I mean, dude, it's the IMF, right? You probably drop by the IMF website, what, once every 3 months? Right? So anyways, the reason I say that, like, okay, so I got to this page because I was just, doing my normal research. But, like, not long ago, they released the World Economic Outlook, so they update this several times a year. So, like, yeah, you're reading this stuff, right? Okay. So, once again, I just assume you're doing this kind of work. So they're telling you, it's interesting because they'll tell you, they're analyzing things from their point of view with the data sets that they have through their own math, and they come up with predictions for the future, right? So, like, where do I get my predictions for the future? I do research, right? So anyways, here they get their PhDs and their quants together, and they analyze their data sets using their own methodologies, and they spit out ideas based on research. So I read these things, and I'm like, okay, that's interesting. Okay, but like, and like I said, they update this a couple of times a year, so you should be paying attention to the IMF, right? I mean, I think it's right on their homepage too. Where is it? I'm sure here's the data mapper. Do they? Oh yeah, right here. Here, look. Here's the January update, right? World Economic Outlook. So you must be reading the World Economic Outlook. Okay? I mean, come on. So I remember like 10 years ago, we would read the World Economic Outlook, and I remember one of the things I was talking about was our aggressive stance on the Great British Pound. Right? And so we'd read the World Economic Outlook, and what they had done is they revised their outlook for not the British pound, but the UK economy. They revised it upward where they're like, okay, it's going good, but it's going to get even better. And we were already long pound, but now we're like, now we're longer pound, or at least we're still committed to buying pound, right? Back then. So it's like, it's nothing new. This is something that you should be reading. But anyway, so that I had that open earlier. Another one that you might find interesting. So I was on the South African Central Bank's website, and here's their recent. This was what late last week. This is their monetary policy statement. The Central Bank of South Africa. So again, I'm assuming if you trade the South African rand that you're doing this kind of work, right? That you're reading. And I'll tell you, it opens hot right off the bat, right? A second wave of COVID-19 infections has peaked in South Africa. Whoa, 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 whoa. Okay? And although the virus will continue in new waves, a rollout of vaccines is expected to boost global growth prospects generally, right? The distribution is going to be slow, uneven pace. So other countries are going to get it faster. Whatever. So you got to read this, and it's interesting, and what they're going to do. Okay? So if you're trading like exotics, for example, now you might consider this more of a commodity play, which is fine. But if you're treating this like a carry trade, what other emerging market currency can you be trading to collect a carry? What's sort of another choice? And by the way, if you don't know, right, if South African Central Bank is what I always type in. But anyways, if you need a link. What's another one that you could do? You're like, okay, the South African rand is going to be impacted by their monetary policy, right? So you're like, you're going to read this stuff. Okay, let me get rid of that guy. Okay, so what else could you look at? Yeah, Mexican peso, right? So check this out. Here's the Banco de Mexico, right? So yeah, you should be reading their stuff too. So here's the monetary policy statement. This is a little bit old, right? A couple of weeks old, but here's the point I wanted to share. And for Thor, I think Thor's in the room. Thor's like, hey man, he's kind of interested in the fundamentals, and should I take the course and stuff. So let's talk about that. What impact does the central bank's monetary policy have on a currency? Okay, that's the question. Or even the question could be, does a central bank's change in policy impact a currency? Okay, so let's take a look. So let's say you read this thing. It's barely a page. If you get rid of the logo, it's only one page. Yet I'm going to show you, it directly impacts the value of the currency. One page. You have to read one page. And by the way, it's in English. How nice. Thank you, Banco de Mexico. Check it out. Blah, 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 blah. Global economic activity continued to recover in more moderate rate heterogeneously. Wow. What does that mean? It's the same thing that South Africa said. South Africa says it in plainer English. Where does South Africa say it? Here's their statement. Although new ways, a roll of where does it say it here? I thought it said it right at the beginning that it was going to happen unequally. Oh, an uneven pace. Okay? Uneven pace. And then Mexico says an uneven pace. Okay? Across countries and sectors. Which means there's sort of like a V-shape, not a V-shaped recovery, but a K-shaped recovery. So while the OECD, aka the rich countries, will get their vaccinations quickly and their economies will recover, poor countries are not going to have that same benefit. They're second in line. So Mexico's saying that as well. Otherwise, it'd be homogeneously, not heterogeneous. But anyways, check this out. So this was 2 weeks ago, right? So let's get to the meat of this, because it's only one page. The risks for inflation, economic activity, and financial markets pose major challenges for monetary policy and for the economy. We're talking about Mexico. In this regard, it is necessary to enable an orderly adjustment. Change, yo. Change. It is necessary to enable an orderly adjustment that allows for a change in in relative prices without affecting and inflation expectations. Okay. Considering the incoming information, right? Considering that the incoming information allows monetary policy adjustment, okay? With the presence of all its members, the governing board decided to unanimously lower interest rates by 25 basis points. So, let's talk about this. On the 11th of this month, Mexico lowered interest rates. This is what I'm getting to. Okay? This is what I'm getting to. On the 11th of February, Mexico lowered interest rates. What does that have to do with anything? The 11th of February. Okay, right there. Okay, so what happened to the Mexican peso starting that day? Do you see any sort of impact of the value of the currency? Okay, the Mexican peso, the absolute next day, okay, started going up. I mean, falling. Up for this pair means Mexican peso fell. Okay, the peso has tanked since that very day. Interest rates have fallen in this economy. The value of the currency has gone down. Okay? Isn't that interesting? The change in policy of a central bank is the most important. It's the most important thing, the change in policy. So one day, when you're all alone and the world is cold, one day the Central Bank of Mexico will say, inflation's too high, we will need to raise interest rates from 4% back to 5 or 6 or 7 or whatever, but up. They will have to make a change from cutting interest rates to raising interest rates. Now, it's not going to happen this week. Maybe it doesn't happen this year. But when it does, that's when you start buying peso. That's amazing, huh? So, is anyone sort of guilty of just trading it technically? And you forget these things? Or here's the other way of trading it. You say, okay, yes, Wayne, yes. But that is the bottom. And you already believe the dollar's going to weaken. So you understand that you're still going to try for this. But when Mexico gets better information, why would they have better information? Oh, the United States is going to open up. Its trading partners are going to open up. Everyone's getting vaccinated. By the time summer comes along, everyone's going to be rocking and rolling again. And Mexico, being a large trading partner with the United States, is likely to benefit. Meanwhile, they also sell a lot of oil, and oil's gone up. So, yeah, okay, the Reserve Bank of Mexico is a little concerned that their recovery is going to be slower than OECD countries like the United States. But the inevitable improvement is here. So the next policy change from the central bank is likely to say, we are no longer going to cut interest rates. There's no need. Yes, the economy is still below potential GDP, but the future outlook has improved dramatically, which means then 2 or 3 meetings after that meeting, which is a future meeting. So now we're talking about by the end of the summer, Mexico's like, hey, everything is much better than we thought, and we don't need to be so accommodative. Now we're worried about inflation, especially if you see what's happening in the United States, so we're going to have to raise interest rates. And now you're just like, bah! Everything is going your way. Are you going to go my way? I just got to go, yeah. Okay? So you're like, okay, yeah, so you're going to trade trepidatiously? You're going to tiptoe into this one and say, well, I'm going to still take the swing trades, at least based on the dollar, and maybe an improvement in an economy that is commodity-based and related to trade with the United States. And, you know, Biden's going to go down there and say, hey, I'm not Trump, you love me, right? Right? And so maybe those relations will improve and all that kind of stuff. Good, 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 fine, fine, fine. So at least have the logic before you trade it. Okay? Okay? So Thor's like, hey, should I know fundamentals? Would it help me improve? Well, one thing that you could have done, Thor, is said, well, I read I read about the new policy that the Central Bank of Mexico is going to do. So now I'm going to sell peso for a while as the value changes. And then you go into a swing trade, which is a boring swing trade right there. And there's the target. Here's the new swing trade. There's the target. And you're like, oh, nice, nice. And you're trading this up. Or at least you understand why the peso is weakening. Because you're like, oh, well, they cut interest rates, so that makes sense. And you're done. You understand why this is happening. Now, you could be just trading against it because you say, well, Wayne told me something about something down, and whatever, dude, right? You always want to be independent, right? And have your thought process. So yes, this can go down. It may go down. Historically, it would go down. But you remember, a change in policy here is not the same as historics. So if historically, maybe we would like to sell this, but at the very least, you'll understand the technicals. Okay? Okay? So I kind of set you guys up for a learning experience yesterday, right? I told you yesterday that these charts did not show us any direction, and that we were right here, and that if you were a bull, it would do this, and if you were a bear, it would do this. How many people remember that? And I said there was no real way to know. We're essentially neutral, so it's going to come down to your bias. How many people remember this from yesterday? That's why I drew this whole gray area. I'm like, now I do, right? But remember, like I actually set you up. Like, well, then it comes down to what your bias is. Now, the part I don't like is when your bias is based on something that I said. That's why I kind of, like, I try to challenge you to think. Okay? Michael says, added the Bank of Mexico. So it's one of the better central banks, actually, Michael. You know, I used to read stuff. I used to download Karsten's PowerPoint presentations in Spanish just so I could see the economic charts and try to figure it out. Karsten's is no longer in charge. It's a new guy. I forget his name now. But anyways, yeah, it's one of the better websites. It's a great central bank website. Okay, so let's go back to this. So yesterday I kind of set you up for a learning experience. I'm like, so it really depends on what your bias is. If you're a bull, it's going to go up. If you're a bear, it's going to go down. Okay? And you're going to filter everything else out. Now, in this case, you could say, well, on peso, I'm a bear because they just cut interest rates, 2 weeks ago. Okay? Now, on top of that, you could say, well, we also want to sell this based on repatriation flows. But do you remember at some point I said it was too early, if you recall. I said maybe by the end of the week. So for you repatriation flow traders, you're probably looking at something like this. So you're waiting for a double top. But it's Thursday today. Thursdays are the best days. Today's Thursday, so you actually might be setting this up front-running tomorrow's repatriation trade. But that's your call, son. I don't know how aggressive you are, but you certainly can be setting that up because that's not a fundamental trade, isn't it? Right? It's a flow trade. Irregardless of the central bank and its policy, people are going to send money home. They're going to go to Western Europe. They're going to go to Western Union, irregardless of what the central bank's policy is. In fact, they don't even know. Like, how many people even know a central bank's policy? What percentage of any population? Nobody. So, like, they're going to go to Western Union and send money home anyways. So that's going to happen. We don't know to the degree, nor do we know what the dollar's doing. But we know generally the dollar is not strong. But it's strong versus peso, and that is, so this is an informative information, right? So now you have to interpret this. Are we going to head up for months, or is this just a shorter term move? Okay? Well, this is where you do some analysis, and you say, well, based on that, this is an S1, so the projected top is right here. Okay, so this change of information, however, is not a technical change, it's a fundamental change. So you could definitely argue and plan for that this has some up in it for a while, for sure. Or you stay range bound and the dollar weakens when the dollar's, right? Okay. Okay. So you have to wait your turn. That's why you now use technical analysis to confirm or deny market conditions. Mm-hmm. Oh, hope. My master's degree does not prevent me from sticking my foot in my mouth. All right. Let's go here. I guess we got to get ready for some GDP, eh? Everyone's Googling now. What GDPA? Where did it go? Oh, it must be here.
You're listening to Trade the News.
I wanted to show you one other thing today. What was it? Oh, you remember I was saying that the $1 trillion that Trump got way back in like November, December, the Trump $1 trillion stimulus package, I said the $1 trillion is still sitting in a bank account. You remember that? And for some reason, apparently now we need $2 more trillion, but we're not even using the first trillion. Remember that? Guess what? So Biden is thinking about using it through FEMA. Okay, FEMA, the Federal Emergency Something Administration, Emergency Management, right? So FEMA, if there's a natural disaster like something that happened in Texas recently, or if Florida gets a hurricane or something like that, FEMA goes out there and provides support. Okay? So now Biden might use the FEMA money to provide $2 billion to assist COVID-19 deaths with funeral money. $2 billion from FEMA is going to be used, there's a proposal to use $2 billion of the FEMA money from Trump's money and give it to people for funerals. Not to prevent COVID, not to cure COVID, not to help people, waitresses out of work and landlords not getting paid, but simply for people that can't afford a funeral. Now you can get some Biden money for your funeral. And I thought, well, and through the Federal Emergency Management Agency. And you're like,
just over a minute to the bottom of the hour.
Like, what does that have to do with FEMA?
Fourth quarter GDP, quarter over quarter expected at 4.2%.
Yeah, but funeral home stocks
right. 2.0%. Core PC
are probably going to skyrocket.
Weekly jobless claims expected.
That's right, Jean-Guy. Very good.
Claims expected.
Very good point. I didn't even think about that. Yeah, but you're not even allowed to go to the funeral.
At 1.1%, ex-transportation seen 0.7%, capital goods orders expected 0.8%, and shipments seen 0.6%.
Okay. This is Trading News, by the way. I guess you can kind of see it.
We'll get our data in just a few seconds.
NetX came out. We'll get that.
Capital goods 3.4%, up 1.1% expectation. Jobless claims 730,000, below this 825,000 expectation. Continuing claims 4.42 million, below the 4.46 million expected for continuing claims.
I don't care about
durables, ex-transportation at 1.4% versus 0.7% expectation. GDP at 4.1%. 4.1% is 1/10 lower than expected for Q4 GDP.
Very nice. Let me get that one for you first. I don't care about the weekly jobless claims. I don't care about durable goods. All right, so let's move on and take a look at the stuff. So this just came out. Okay, so, you want to look at things like potential GDP and where we are relative to that. Okay. Now, you should know about real GDP, current dollar GDP, the difference, right? Nominal versus real. That's right out of my macro course that we started 5 weeks ago. So you can take a look at this. This is all the information. Of course, you're supposed to analyze this and make decisions on what you like. Okay, great. So that's the information. PCE just came out. Let me get you that information. Hang on. Hang on. Where's that? Let me get this. It's a different part of the website. Hang on. So everything that's coming out right now is from BEA. Oh, wow, their site's slow. I guess everyone's pulling it up. All right, so here's your PCE. This is used by the Fed. Okay, so 1.5% change in GDP, PCE. So you can take a look at the release. Okay. And PCE, okay. Down, right. Look at 32004. Improving, right? Okay, you see that? It was heading down, then it stabilized at 0. I guess they probably just quit counting. And then back up. Okay, so this is all going in. Okay, chained and unchained chained dollars, all that kind of stuff. Fine. Okay, now you should read this if you don't understand it and all that kind of stuff. But this just, in of itself, is just another data set that goes into your analysis, right? So now we go, let's go over here. This is probably the biggest one that just came out. Okay. The biggest part here is Duke and Duke, the crop report, right? No. This should show us, if I have it here, exports. No, I don't remember. How come I don't have this? It should be here. Chickens and eggs, dairy. What's the date today? 25th. In here, 4 more. Crop value, livestock, trout production, chicken and eggs, crop. Oh, I must have pulled up the wrong site. I just want export data. Let me try again. Am I USDA? Yeah. Okay, let's start over again. USDA export report. Let's try that. February 5th. All right. We don't. I don't want. Guess we'll just do this. Okay. I forget where it is. There's a prettier version of this, of course. Accumulated exports of soybeans to the Netherlands were adjusted down. Okay, we don't care about that. Anyways, why do we care about exports? What's up, Tommy? Why do we care about exports? The flow of money, yeah, and it's part of GDP as well. Okay, but it's literally the flow of money. Because remember, if we export hard red winter wheat to Japan, our balance sheet stays balanced, right? Except we have less hard red wheat than we used to, right? But we received more dollars, and Japan had to buy those dollars first. Okay? So it impacts the flow of money. I thought we had, I can't remember where it was, maybe, anyways, complete weekly report, highlight, summary activity. Anyways, you can get some better data chart-wise, but, okay, that just came out. GDP came out. There's GDP. PCE came out. So that's all on the BEA website. So you just go to bea.gov. Anyways, right? So I'm trying to get you to think a little more. That's all. That's all. All right, cool. So here is our euro dollar. We started the month out of position. Okay, hit the target early, sets up a counter trend. We're supposed to get back to the central pivot, and now we are through. Very cool. Now, I think, generally speaking, this will continue for the rest of the year. But you already know that. You already know in November and December, up, January down, okay? And either February or March would give us our bottom. Okay? Oh, USD.gov.oce. Yeah, okay. I have some other one in there. Let's, February. I mean, it's good reading. What I'm trying to find is a change in total, almost like a COT report. Okay. The supply and demand outlook for wheat is largely unchanged this month. Okay. Oh, those crazy Kazakhs. So yeah, this still isn't quite what I'm looking for. Maybe it's this one. No. Milk prices. 18. Lower. Lower. Okay. Milk prices are still falling. Like I was saying, I think on Tuesday I was saying that the two largest milk producers in the United States have gone out of business. Okay. Well, Thoraxel, you're going to join FX Bootcamp, right? Take the fundamentals course. It's actually more monetary policy. Okay. Why are prices falling? Well, we've covered that on Tuesday in the macroeconomics course. And you can say it could possibly be a supply issue, which would, shifting the supply curve would come down to things like maybe a change in technology. Okay? It could be a change in demand, and one of the 5 things that shifts the demand curve would be like tastes and preferences. Americans, for example, just drank less milk than they used to. Okay? It might be a demand issue because of competition or substitutes. Those are both changers of a demand curve. And maybe people are deciding in the United States, instead of drinking milk, they want to drink soy. They want soy milk and not cow milk because of the poor cows. Okay? Okay? Interesting, right? So, does anyone remember the shifters of the demand curve and the shifters of the supply curve? You don't have to type them here, but yeah. Okay. So that's in the macroeconomics course that I do on Tuesdays. Yeah, the coupon code is COVID-19. You don't have to copy and paste. You just type it in. COVID-19. All right. All right. You know, it'd be really confusing if I told people the coupon code was coupon code. And you're like, what coupon code? Just type in coupon code. Well, what's the coupon code? Coupon code. Yeah, I need the coupon code. It's coupon code. Just type in coupon code. Yeah, exactly. All right. La-di-da-di-da. So there's the peso. Here's our Kiwi dollar. Okay. Now notice we were here, huh? But notice also this was important. Right? You can see we stopped there for a couple of days, waited for the 21 to catch up, and then we popped. Okay? We're through our target, which means it's dangerous, right? You would never sell, but you certainly can take profit. Okay? Okay. So now your issue is you have to be patient and disciplined. Are you still a bull? And if so, at what price would you buy it? And most people can't do it because they're like, well, I want to buy it now. It's way up here. You have to say, no. Based on your analysis, you might buy a retest around 74. So it has to come down at least 50 pips. But it might, right? But, right? It might, right? All the way down to maybe 73. You might have to wait. Okay. But a lot of people can't do it. But they're also the same people that can't say, all right, fundamentally, your bias is long Kiwi dollar, and you believe Kiwi dollar will be higher at the end of the year. So, while it makes a double bottom here, do you buy it? Maybe not. But then it makes sort of a higher low. Do you buy it? Well, maybe not. Okay. Higher high, higher low. Do you buy it? Maybe not. Maybe not. But the issue is, what is your conviction in this zone that it will go higher? that this is actually cheap, where you're like, well, technically we're in a trend. Yeah, the trend is slow. Okay. But we expect that to happen in January to open down. But when do you start tiptoeing back in, and what is your conviction that even if it's moving generally sideways, I mean, you could argue it like it's kind of sideways, but statistically the slope is positive. So you could say, well, I'm buying it cheap. Okay? You're buying it cheap. And then also your analysis technically is telling you this is higher than the week before, this is higher than the week before, this is higher than the week before, right? And then she wakes up. You wake up the giant. But the buying down here is emotionally difficult. But also waiting up here is emotionally difficult. And those that don't buy here probably do buy here, and that is what leads to failure, that they don't say, oh, well, you know, I've analyzed this and this might be cheap. And now they're in it and they're like, oh, now I want to buy it way up here at 75. Well, that's also wrong. It's reactionary. Right? Like when you're a stock trader, you might say, well, you know, a 7% decline in Tesla gives me an opportunity to buy. Right? You get that? A question here, Wayne, the dollar fundamental looks good. What impact on USD pairs? Well, to answer that question, at the end of March or the end of April? When is it? April. I think in April, I declared the US dollar to be weak. Well, at that time it was very strong. But that the US dollar will weaken for at least 5 years. So, Uche, that hasn't changed. Okay? More people believe me now, but that goes all the way back then. Okay? So I use now fundamental analysis to say, should I change my bias? That's all. So PCE came out. Should I change my bias? No. Okay. Now technical analysis tells me, is it a good price and is it a good time? Because the only thing on this chart is price. Oops, sorry. This over here, it's all price. And over here is time. So that's all there is. So when you use technical analysis, there's only price and time. Then you use candlesticks to say, well, what happened in that individual period, right? Okay. And then you use moving averages to say, well, what's a smoothing trend? And use a combination to say, well, this means this is more up. The faster one is rising above the slow, so this is bullish, and this is kicking off a trend, and then the color of this tells you what happened in that period. And then you can use like an oscillator that measures the distance between the two moving averages, so a MACD would be doing something similar. Right? And now you're like, oh, I guess I should be buying. But the fundamentals tell you way before, and also last a lot longer, because if the if the technicals are showing down in the moment, all you need to do is say, well, fundamentally this is still up, and in the next 2 days, 2 weeks, 2 months, we're likely to be back in this direction. So as a technical trader, I'm going to wait for, from this moment on, I want to wait for this part. Okay? Because this might be creating lower lows, and what you want is higher highs, lower highs, and this might be creating higher lows, and you just kind of skip this period because the market conditions are not favorable. That's how you should be using technical analysis, right? Greg, they announced that like 2 months ago, Gregors, that Coinbase is doing an IPO. Yeah. Cool. All right. So what that does is gives you conviction to say a move like this is an opportunity to buy because you already know this is going to go up. Now, you think you know, but in your mind you know. The research that you did tells you that the Kiwi dollar will go up. So going into January, you know this is not a good time to be buying. Okay? But at some point, you decide, and it might be this point, literally, that we had the up, now there's a sideways, okay? And then eventually an up. And we know that the end of January is important, so let's mark January. Let's do this in a slightly different color, and let's use the drawing tool. So we know February 1st is important, and we also know March is important, okay? And didn't we say somewhere between February and April, which means it's some period inside of February or some period inside of March, a currency pair like Kiwi dollar would go up. Isn't that what we said? I said, I don't know when, but I believe it's somewhere in that period. And then I said, I don't think it's going to be at the end of the period. And I don't think it'll be sort of at the earlier part. I mean, again, it's a guess, right? It's more likely to be early, but it doesn't have to be early. But it certainly shouldn't be late. So really what you could say now, or what we did say, is maybe like middle of Feb to the middle of March. Okay? That we would rotate out of yen, and in yen pairs being weak. Because remember, during this period, right, we thought the dollar would be strong. Oh, and it was. Then somewhere like middle of February to middle of March, we want to rotate out of weak yen and start selling the dollar. So I just don't know what day or even what hour or even what week. That's why I'm saying might be this week, might be next week, might be 3 weeks from now. We don't know. But at some point you have to start building your positions. Okay? What do you think? Is it starting to make sense? Are you going to think about your trading differently next year, having gone through this experience? Right? The one thing I've been clear is I have a general idea, but I don't know. So you have to use the general idea as a lens. The general idea being, okay, here's the general idea that we set up 6 months in advance. This is definitely an out. Dollar will definitely get strong. And then in this period here, between February and March, we will definitely be selling dollar. So like the assumption was we are definitely selling dollar, definitely. Without a fact, generally speaking, in this time period. But every little day, every little dip, every week, I don't know. That's why you have a chart, son. Do some analysis. Okay? So we definitely know we're selling dollar here. We definitely know we're buying dollar here. Okay? Definitely. Third week rally and everything. See the third week rally? The false rally? Okay? And then what? We definitely know in this giant period, it's, but you could look at it as an 8-week period, but you could simplify and say middle of February to middle of March, that's only a 4-week period. That's why I'm trying to get you to think outside of a 15-minute chart. Not always, but sometimes, to say, well, somewhere in that 4-week period, we will definitely be selling dollar again. Okay? And now imagine how awesome you're going to be on your day trading when you're thinking, here I definitely want to be selling dollar, here I definitely want to buy dollar, and then somewhere in here I'm going to look for a bottom and then start selling again. Okay? Richard, no, I'm not going to do USD Swiss franc because they're both funding pairs. But we know Swiss franc is super weak, but I also think dollar should be weak. So no, I would never want to look at that, Richard. It'd be like, to me, it just doesn't even make sense. Okay? Because, right, like, I don't know what you're doing, which is fine, right? Like, we don't have to be doing the same thing, nor are we likely to always be on the same time frame. But here's what I want, and this is why I'm not going to look at it, Richard. I believe the US dollar will be weak most of the year. Not every day, not every hour, not every week, not even every month. But if I had to throw down a bias, I'd say, okay, dollar weakness. And I've had this for about a year now, almost exactly a year now. A year ago, I said, I'm going to be selling US dollar every single day for 5 years. It's been generally true for one entire year. Okay. Now, I also said the same thing for Swiss franc. And this one I have not been so correct on, to the point where I believe there's some sort of reason for it that I don't understand, but I'm confident enough in myself where I'll tell people it's strong, but I think it should be weak, and then on times it's weak, it should be strong, and it's decoupled, and I don't get it, and I don't really understand, so I don't even want to look at it until I see it correlating again. But irregardless of whether it's correlating or not, it's still my fundamental bias of what should be happening. Okay? Now, in the last couple of weeks, the correlation has come back. And I don't know if that's the central bank stepping in or if it was the central bank stepping in earlier. But irregardless, now we're back to this situation. Regardless of what the central bank is doing, I think the dollar should be weak. I think the Swiss franc should be weak. I've thought that since April of last year. And so now you're like, Wayne, show me, can you do a USD Swiss franc trade? I'm like, but bro, dude, I think they should both be weak. So how could I possibly analyze it? You see? That's why I back off, Richard. I'm just like, well, I will look at it and I won't believe it. I won't like it. I don't even want to see it. So therefore, I'll just back off like, no, sorry, bro. I will not do USD Swiss franc because I'm personally fundamentally neutral. So, no, I don't want to look at it. Okay? However, what did I tell you guys? I think it was a week ago. I told you pound Swissy. Maybe 2 weeks ago. Does anyone remember? Maybe you took the trade. I explained the pound Swissy one. I think the way I said it is, when we finally noticed the correlation was back with Swiss franc, which is a good thing. Okay? I said, one of my favorite trades of all time, just in general, like one of my favorite trading pairs, was the pissy pound Swissy. I'm like, I like pound Swissy. I miss pound Swissy. If I was going to sell, right, that kind of thing. And so now if we look at a pissy trade, a pissy little trade, here's your CAD Swissy. Oh, here's pissy. Oh my God. Oh my God. Oh my God. Oh my God. This is a 4-hour chart. Oh my God. Oh my God. Okay? So, let's see. Let's see if you can, right? It makes a higher low, you buy it. It makes a higher low, you buy it. You make a higher low, you buy it. Makes a higher low, you buy it. Okay? Higher low, you buy it. Higher low, you buy it. High. Okay. Notice the increase in acceleration. The separation between the 2155. This would be a very easy chart to draw MACD. If I gave you this chart and said, draw the MACD for me, and you can't do it, then you don't know MACD. It'd be very, very, very easy. Okay? And all you'd have to do is draw, let's say, here's the 80, here's the 20. Okay? Well, here's the water line. Okay? Draw the MACD. If you can't do it, you don't know anything about MACD. Right? Just straight up simple. So you could either do it because you know, or you can't do it because you don't know. And if you don't know MACD, like if you don't know how to draw it, you should stop trading it because you don't even know what it's telling you. Right? There's two gauges on your car that you probably understand. Speedometer and gas tank. Gasoline levels, right? You're like, well, what's that little thing with the little oily thing? And what's the little thing with the thermometer thing? Okay? Is that thermometer thingy, is it important? Should I know what it is? A lot of people don't know nothing about their car. It's a tea kettle, yeah. Means your tea's ready. Yeah. Very cool. All right, so Swissy is looking good. Okay, so you see straight up, straight up, straight up. On 4 hours or dailies. Check this out. Then you drop into a 15-minute. Okay, here's the 15-minute now. And you're like, well, that doesn't look up or very up. Or it was up, but now it's not up. And there's the point that I'm trying to make. Well, actually, I didn't even notice what this is. And I was just dropping into an example. Then I realized I backed off and I'm like, wait, this isn't what I wanted to see. And then I noticed it's Swissy yen. So I'm going to use it for a different example because I thought I was going to show you a timing issue, but this isn't. I back out and this trade sucks compared to everything else. So Rashad, was it Rashad? Rashad? Richard? No, Richard. This goes back to your USD Swiss franc trade. I don't want to even look at it because there's not going to be a trade there. This is the same thing, Swissy yen. It's like USD Swiss franc. They're both funding currencies. So Swiss franc yen, I don't even want to see this chart. But check it out. It was this way, now it's that way. Which way should you be trading? And the answer is neither. Now, look. Can you trade it? Yeah. But I would never. And notice how I've even highlighted this as sideways. I would never want to trade this. Now you say, well, Wayne, this was a buy zone. Your stop should be down here below the S. This was the target. Wayne, I could totally be trading this. Yeah, but the issue is, what's the predictability? So the up and then the down, you're not going to get consistency because this lacks a fundamental trend. You might get technical entries, but your technical analysis is going to be much less reliable because there's no fundamentals behind what you're doing. So it doesn't really matter what time or price you're buying it. You're not doing the right thing. You might have the perfect price, the perfect time, but still lose money. Okay? So what else would be a better trade here? Okay? So then you're like, so this is Swiss franc. How about Aussie Swiss franc? Oh, why is this one better? Well, this is a great China play. Okay? Notice the swing trade, ladies and germs. This is straight out of the swing trading course. Okay? Up, 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 down, down, buy. Up, 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 down, down, buy. Up, 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 down, down, buy. Up, 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 down, down, buy. Up, 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 up. What happened to your USD? No, what happened to your Swiss franc Japanese yen trade? It went up, it went down. What happened? Nothing. Well, this one has fundamentals behind it. This is a great China play. This is your China play. Okay? Boom. It's just a better trade. Okay? Here's your GameStop trade. This is your Amazon trade, right? Yeah, so Richard was interested in buying USD Swiss franc, but like I'm telling you, there's no way I'd want that. That's one of the dumbest trades, fundamentally, that you could possibly do. You would just have to throw down emotionally and say, I just don't get it. I just have no idea. So I'm going to use nothing but time and price to decide what to do. Well, at the end of the year, you'll probably still be profitable. Technical analysis is wonderful. But you're going to be significantly less profitable than if you knew the reason why something was moving. Okay? If you're like, well, I bought a moving average crossover with an RSI kicker and it's going up. Great. When are you going to get out? Actually, I don't know. Well, then now you're trading blind. And then, of course, if it drops, you won't see it coming and you won't know why. And that's going to be the problem. And so now you're buying drops instead of dips, and now your technical analysis will let you down, where fundamentally you could have just bought this here and walked away, and you're done for the entire year. You might be on this trade, long on this trade to December 31st. Why? How could you make a decision like that? Well, that's what fundamentals tell you. Okay, specifically macroeconomics, okay, and monetary policy. Okay? Okay? La-di-da-di-do. Yeah, so today at 2 p.m. I will be meeting with my swing trading group to plan next week's trades. Right? Last week, the most popular trade that the group came up with, like I said, probably it was 3 groups, 8 people each? Okay, so I don't know, 20, 25 people all agreed that USD CAD was going to be their trade of the week. And here's the entry. And they may have already been taking profit. They may actually be out of this trade, even though it went further. But those 25 people came up with generally the same plan. By the way, we were here. So basically sell at 27, go for 25, 200 pips. Boring. So Congratulations to team, what was it, team 2, 3, and 6 or something. 2, 3, and 5. Okay? And if it looks easy, realize that we spent, right in this period actually, we spent right in this period 4 hours of debate. And the most popular trade plan that came out of that 4-hour debate was sell this pair. Okay? It's not me coming in like, all right, I'm going to give you a trade, guys. Here's my alert. I'm going to give you an alert. This is my alert. Let me tell you what to do because you're a child and you don't understand, right? That's not what the swing trading group's all about. So I consider it like I'm a fund manager and I'm meeting with a group of portfolio managers and their analyst teams. And we get together in the war room to hash it out, to battle it out technically and fundamentally. What, right? Debate. What are the best trades? Where should we deploy our capital? Let's put our minds together. Okay? That's why it's a war room. Okay? It's kind of emotionally and mentally loud. It's not me coming in like, all right, everybody. Now, I did tell everybody to sell the dollar. So let me be clear about that. I told everybody, sell the dollar. Your job is to sell the dollar. But then I got people in the groups. I'm like, go through all your charts, go through all your fundamentals, hash it out as a team. It was about a 40-minute discussion there in groups. And I'm like, your group needs to tell me, the fund manager, where we're going to deploy our capital. We're going to dump the dollar. What are you going to buy? Recommend to me, your client, recommend to me the best trade. Pretty cool, right? And then I tweeted a picture of an ice cream cone and everybody dumped the dollar at the same time. Boom, we got paid. Okay? But notice, why do we meet on Thursdays? That's a big one, right? Because when we met, that was the top of the market. This is why I say if you show up on Monday, here's Monday, by the way. If you show up on Monday and you don't know we're selling, you're so far behind, it's funny. Like, you won't have a chance. Traders that are prepared will destroy you every single time. And you're like, oh, look, my RSI crossed up on the London Open. I guess I'll buy it. Boom, we sell it right into you. Boom. Fire for effect. There's no way you can beat us. Okay? Because we're more prepared. Okay? And by the way, I have fun in those meetings. So yeah, it was a 4.5-hour meeting, but I had fun. Okay? And that's one of the output. What was another one? So 3 of the 5 groups said CAD. Does anyone in the swing trading group remember what the other ones were? Was it pound? I think pound might have been one. Pound dollar long. Does anyone remember? Template, swing trading, bullish, hourly. It was pound, right? So that one is out of position. Okay, and that one is much more difficult, right? So out of position, and then you got to kill this EMA. Oops, just trying to get rid of it. You want to kill that one and really kill all of this. Delete. We don't need it, so you can kill it. Delete. Kill that one. You don't need it. Delete. All right, so now we have to go insert, indicator, custom, zero lag moving average. And I have to shift it 4. Someday, when you're all alone and the world is gold. Okay? And by the way, this is out. So you're like, well, what about all this? It doesn't exist. And that comes from discipline. If you don't have discipline, you're going to get chopped up. Okay? So So this is an OPP into a CT. And the other part of this is we know it's going to happen early in the week. So by what is this, Tuesday? You're done. And once again, you're like, well, that looks easy. Well, if you don't follow the rules of engagement, then you're not going to succeed. Part of it is buying it out of position, understanding that you're going to hit the target early, prepared to get out at Tuesday. If you're up here and you're like, oh my God, look at, we're way the heck up here. Take your profit because you already anticipate this. Now, we don't know how far, but we certainly can predict at least this far. Okay. And I think at that time it would have been higher just by the way we the way we calculate pivots. So we would know at that time, we would assume something in this zone, okay, is the out. Okay? Okay? So you would not have suffered this. That was unnecessary. Okay? Unnecessary. As a swing trader, you know the up is going to happen fast, so you're not going to get the down. And the consequence of that is you're going to hit your target early, and you have to have the discipline to take your profit and walk away. And it is not easy. Peter says, what happens if price hits monthly R3? What does that mean? Definitely, without a doubt, take your profit because your plan was here. And the only way that that's really happening, Peter, okay, is your plan is here. But the thing is, as a swing trader, you barely ever have to work, okay? Because maybe you did a front run, maybe you grabbed the 4-hour 21 on Monday, but you're not working. Once you make the trade, you drop your stop and you're done. So typically what'll happen is you'll wake up on Tuesday morning or Wednesday morning and you rub your eyes, you're like, oh my God, what's going on? And you reach for the phone. You know, my charts are the first thing I look at in the morning, right? And I'm rubbing my eyes and I'm like, oh, MetaTrader. And I open that up. I'm like, holy shit. Okay? And you find you're right here. And you only expected that. So you're like, oh my God. That's free pips. Okay. Now, of course, you can, okay. By the way, when I say free, if you're actually buying it in here, you absolutely don't know how to trade. You're so reactionary, you're bothersome, right? You're annoying, okay? If you bought down here and you're swinging it and you're in it for, 8 days or whatever, these are all free because we shouldn't be up here. Something's changed. This is very unusual. We shouldn't be up there, but congratulations, you got them. They're free. It's icing on your cake. If you can get out at R3, get out at R3 with those extra pips. Puts gas in the Porsche, right? Great. Awesome. But some people show up on Tuesday and they're like, it's so bullish today, I'm buying. Fool. Okay? Fool. So, right? So that's sort of the difference. And sometimes when I'm expecting sort of a breakout month, that's what I would do. And I don't know if I've put this in a training course or not. So sometimes under certain conditions, what I'll do is I'll buy. I'll put my stop below, support. Okay. Now, when I buy, what does that typically mean? Central pivot to M2. So that's all predefined. Like if I say buy, you're like, oh, I know what he's doing. You could probably draw the chart. I'm just telling you I'm a buyer. You're like, oh, well, he's probably buying. It's probably a fib retracement. It's probably a pivot point. It's probably, a roll reversal. There's only certain circumstances in which I buy. And you also know the market's bullish. So I could say, look, I'm going to buy something, and you can draw the chart. And you're like, I don't even know what it is. It doesn't matter because you know I'm going to buy under the same circumstances. A, I'm a buyer, so the market's bullish. And B, I only buy dips. I don't buy drops. I buy dips. So you're like, okay, he's a buyer, so we know technically the market is bullish. And B, it's likely a roll reversal, fib retracement on a pivot point. Because that's 99% of everything. And so therefore the stop's under S. Wayne, where do you put your stop? Well, if I'm a bull, under support. It just makes total sense, right? I bought at the first level of support, and then my stop is below the second level of support. Where else would you put it? I couldn't even understand where else you would put it. Okay? And by the way, I keep doing this Trump thing. I don't know. Where else would you put it? It's like the greatest thing I've ever seen. Ask anybody. Very intelligent people, by the way, will tell you it's the greatest thing. Like, I don't know where else you'd put it. So anyway, okay, I'm a buyer. So you know the market's bullish. You know the stop's going to go under S1, all that kind of stuff. And then maybe for whatever reason, fundamentals, seasonality, there's a lot of reasons sometime in the year I expect to be more bullish than what the charts will tell me. Do you understand that? There are times when I override my charts because I know technically my charts are wrong. There are times when I know my charts are too conservative because I know how the math works, and because the math is looking at the last period and the last period was conservative, it's going to say, well, this new period is going to be conservative. But that's the problem with only having technicals, especially long term. You're throwing away fundamentals. So someone will come along and say, okay, my chart tells me this, and I'll say, okay, that makes sense. You're totally right, except it is wrong. You're right. That's what it says, but it's wrong, and you're relying on it, but I don't rely on it. I rely on me. So you're reading your charts correctly, but your charts are not giving you the truth. So there are times when I say, well, I expect more. And by the way, we do cover this in our live group. We certainly did this last year a couple of times where I'm like, we're going to blow the doors off these pivots and we're going to go to the next level. Okay? So in a situation like that, and you can try to do this weekly as well as monthly, but I would buy, put my stop below S1 and put the take profit on R3. I don't expect to get there. But if you get the pop, yes. But what's the next point? Absolutely frickin' for sure, take your profit. But the problem is, once you're so profitable, it's hard to do what you're supposed to do. Because we're backwards in our logic. Why would you get out of something that's so profitable? Okay? We know this to be true. A lot of people have problems once they get to 100 pips. They either take the profit early because it's 100 pips or not because it's 100 pips. But remember, the number of pips are irrelevant. If you buy at support, remember that's definitional. I only buy at support. And I only buy if it's an uptrend. So that's easy. So now, if you think about it, you got 3 places to take profit. Resistance 1, resistance 2, resistance 3. Well, if I believe we're a trend and I'm a buyer, I'm not going to get out of R1 ever. I'll never get out of R1. The first level of resistance, dude, I'm a bull. Who the heck gets out at R1? You don't have any conviction for what you're doing? Like, really? Okay, so I'm not going to get out of R1. R2, I love getting out at R2. Love it, love it, love it. But oh my gosh, every once in a while, I'll get those extra pips for free. And we're all the way up at R3 now. And usually that's a mistake. Like, I don't want to get out at R3. I want to get out at R2. So if this pops and I head up to R3, do I take profit? Oh my gosh. Oh my gosh. Oh, faux show. Okay. Where do you get the zero lag? Metatraders.com. I believe it's in the complete toolkit. Okay. Cool, right? But remember, your determination of the top is what's most important. And your determination to buy a dip is what's important. Do you need a zero lag? No, you don't need a zero lag. You could do all of this, I was going to say naked, but there might be a problem with that, though, because the pivot points. But let's do it this way. Okay, your analysis of this market. Okay, you analyze this market, and at some point you decide you're a bull. Well, in fact, you probably already know you're a bull. I can tell you for a fact, way over here, we knew we were bulls. Okay? Maybe not on the pound. Maybe this isn't a great example. Pick another one, maybe. Let's move this. Just let's get off pound, because pound is tricky with Brexit and all that, right? So pound dollar, we could, what's another one? I'll do some random one. Dollar Aussie? Let's do Aussie. Okay. So going back to the summer, okay? The summer we expected up and down, okay? And then November through December we expected up. And then from January to somewhere between February and March, we expected down, okay? And then from this period, we expect up. Okay, that's our thought process. Is this chart helpful to decide whether you're still a bull or not? Yeah. Would anybody sell this? Nobody's sane. Okay. So what if your job is to say, you know, to watch this sort of period, and maybe, just maybe, you're looking for something like this. And from this period, okay, you're just long and gone. Okay. Then you get into this period, and you expect US dollar strength. Okay, so we get this. We expected it. But now you see the pop, and now you're on. You see, with conviction, what fundamentals and macroeconomics do is let you know, especially wrapping around seasonality, that this is an opportunity. You're getting a good deal. You're getting a good deal. But nothing else has changed except price. Okay? You see that? So now what are you actually looking for as a trader? You would actually be quite excited to see something like this for a week or 2 or 3 because you're going to want to buy it. Okay? Okay? You see how helpful that is? It's the mental process, not the technical analysis. There are definitely traders that tried to trade both sides of this trade, and they probably did all right if they were good. But you could just buy it. Okay? You could also do that. Or imagine every time it dipped. Okay? Imagine that every time it dipped, you said, okay, buy the bottom of the red zone, 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 buy the bottom of the red zone. Okay? And then, of course, here's the interesting thing that many people don't know. Okay? We said right here to exit December 18th. We said it 6 months in advance. Cool. Here's the end of January, beginning of February. Okay, and now what? Game back on. So are you buying the bottom of the red zone? What about the future bottom of the red zone? Are you going to buy it? What are you going to do? See, this is why we meet as a swing group. If you don't know before it happens, you're not going to have the strength and conviction or the guts or the discipline to do it because you're going to double guess yourself like, I don't know. And the reason you double guess yourself in those situations is you don't actually know. You don't know why anything's happening. And that's the problem. Okay? That's the problem. Okay? I did a special webinar this day, and I did a special webinar this day, the first day of January, the first trading day of January. I did a special webinar. Okay? Is there a reason why I picked this day and that day? Yeah, there was a reason. Isn't that interesting? Crazy, right? Isn't that cool? Yes, Mihir. But yeah, we've talked about that till I'm blue in the face. All right, I think I'm spent. I think that's it. I guess we'll just leave it there, huh? Uche says maybe scalpers and EAs would sell that. Yes, bless their hearts, as they say in Georgia. Bless their hearts, which of course is an insult. I'm exhausted. Oh my God. Yeah, swing trading. Swing trading, great. I'm always exhausted after that one. Can you look at the ZAR? Yeah, but it's the same thing, Michael. If I did the peso, then the ZAR is similar. I also showed you the central, right? I showed you that I went to the, let me give you the, okay, here, let me just give you a link. I'm not going to do, right? Here, you do the work. You do the reading. It's all about the reading. It's all about the pips, no money. All about the pips, all the bips, no honey. Yeah, so I'll see you over there. Yeah, no, thank you for your time. If you guys are new, please subscribe and like. We got to get more people involved with this community. It's so good. Isn't it shocking, though, that YouTube won't promote this? I just don't know what's going on. It's crazy, right? Like, I like our group. So we have 140 people watching, but then you can go watch another one, and there's like 8,000. I wonder why they don't do it. It's strange. I do my best to give you legitimate, hardcore knowledge and experience. It's weird, huh? Hey, Wayne, to join the swing trading group, do we buy the FX Bootcamp training course? Yes. Swing trading group is not about me teaching you how to trade. If you don't know how to trade, watch the videos. So it's a prerequisite to watch all the videos. Now, can you pay for the video courses and join the live group at the same time? Yeah, because you can pay attention to everything that I'm talking about and everything else your group members are talking about and say, wow, okay, I'm missing some pieces. And then you go back and you're doing the courses and you start picking up those pieces. But you cannot skip the education and go straight into brain surgery. Right, Dorian? You're like, I just want to be a doctor. Can we just speed up this education part? In fact, it's expensive. I don't want to pay for it. Can I start cutting into people? Like, when do we do that? You're like, whoa. Right? Whoa. Slow it down. Yeah, before you start cutting into people, drilling holes into their brain, you should probably at least learn all the Latin words. Right? Let's start with that. Tiger Woods broke his fibula and his tibula. Okay? Where do they exist? Right? Yeah. Okay? Your tibia and your fibby. So anyways, I wish him the best of luck. Peace on earth. May the pips be with you. May our profits be above average. I'll see you later today or tomorrow. Thank you for being on my team. I don't know how many times I've said it, but I appreciate it. You're good people. You provide me with inspiration and energy every single day. You make me want to be a better trader. And so I'll see you later today or I'll see you tomorrow. And thank you to Traders Way for being part of our community as well. You take care of yourself, y'all. All y'all.